Well, hello. We're going to revisit the DAX. Very early morning. And a warm welcome to one and all. For those of you who have not seen me before, my name is Langers, and I am the coffee-obsessed scruffy trader. And I need to be today, because boy, do we all know Scruffy likes a coffee. It's 7 o'clock in the morning, and what I'm trying to do is revisit the DAX and see if we can find some form of a strategy that you can trade around your day job and just build up a little account. That's the general idea of this video and a few videos going forward. So a little housekeeping before we get into it. If you like all things trading and you like what you see today, please subscribe to the channel. It genuinely helps. Drop a comment below if you've got a query, because I do answer every single one. And if you want to expand your trading a little bit further, go down in the description. You'll find details of the Scruffy Squad Discord group that I run. There's a free Telegram group down in there as well, where you can talk amongst yourselves without some clown trying to sell you a signal service, because they're not allowed. As soon as they get in, they get kicked out. Brokers that I recommend, where you'll get free education if you use the links, and also discount code for the 5%ers, a prop fund I work closely with, and you see my statements, etc. So with all of that, what are we doing? Well, like I say, I'm trying to find an early morning trade that is easily recognized and can kind of be repeatable. Now, trading is not necessarily mechanical. There are plenty of adverts kicking around. There's a one which is centered around the DAX, trading without emotion, and it's good. Oh, you must trade with rules. Stupidest thing I've ever heard, because they've all got rules. You need rules, but what you actually need is a framework to put those rules in, and that's the difference. Mechanical systems simply just don't work. It's flicking a coin. You need to be able to look at a chart and read it to a certain degree. Now, reading your charts can be looking at levels, looking at how indicators are applying to the price, but mainly price itself. And it's how the price reacts at certain key areas. Now, once you've got your head round that, the rest of it then becomes a rule-based system. And the rules are very simple, right? I will not get in unless X happens, but why does X happen? Is it just simply technical? In other words, the price just doing what the price naturally does? Or is it an extreme volatility caused from a fundamental news spike? Because that can happen, and this is where mechanical systems fall down, because it's kind of 80-20. It's 80% technical, 20% fundamental, news driven. So if you were doing mechanical over and over, 1 in 5 is going to throw you out straight away. Then you've got to look at your win rate. You've already knocked 20% of your win rate off because you can't account for that. It then pulls your winners all the way down, and then you have to go into the fabled risk reward of 1 to 3. Well, I put many a hole in that, because when you're day trading, that is quite difficult, because tight stops don't work. You need to let the trade breathe, and because you're allowing the trade to breathe, you need to be pretty certain what you're doing on the point of entry. Otherwise, you're going to get yourself into a world of pain. So now I've had me little bit of a ramble and a bit of a rant. Let's have a little look and see what's happening with these charts. Okay. So the first thing I ever do is I'll look at a clean chart. Now, looking at this, you will say, well, we're going up. It's got to go up. Well, I'm going to short it. And I'm going to short it because I can see it here. Very, very simple. Why? Overextended candle. It's failed to make a new high. And then it's going to come down. But why will it come down? Well, it's because it's part and parcel of what this market does. So first of all, we're just going to put in 2 parameter lines, just like so. There's a trading arena. Why is that? There's the top, there's the bottom, intersecting through a large overextended candle. Right. Drop this down to 5 minutes so we can see exactly what's going on, because you might think, well, that looked a bit tight. It doesn't look that tight anymore, does it? Not really. So now what we need to look for is a reason to get in. Well, I can see it on my other screen. And it's now 7:05. That is the initial burst here. You can see that's starting to turn red. Time to come down. We can drop an order in. Very, very simple. Now we're going to put the order at the base of this. And we're not going to go mad. Just a couple of quid a point. Just like so. And then we're going to target around 10-15 pips. So we'll just set it to there. And why is that? Well, it's very, very simple. It's either going to revisit the tops of here, or it's going to revisit the tops of there. Now, if I'm to do this one here, as you can see, it's 6 pips. Not a lot of, not a great deal of money in it. But if we pull it down to the next section, because remember, we're looking for about 15 pips. You know, that's 14.3. Okay, cool. Right. So it's give us an idea of where the market can go to, which is basic market structure. And that's all I'm doing. It's just basic market structure. Now you'll notice the price is underneath where that other one was. That's because I'm going to make the price come to me. I'm not going to chase the market. Now I have an upper point, which is here. And this was done very quickly, hand drawn off the 1 hour, just to give me a quick zone as to where I want to trade in. Anything past this point means my idea at this moment in time could be wrong, you know, or support and resistance swap round. You know, support comes resistance, resistance comes support. You could then work out a new zone on the top and then use this as a bounce point. However, at the moment, what I'm using it for is this arena. So I really want to cage the price between that level and that level. And what I'm looking for is an order to be triggered, get to here, and then that will be it. Done. Just one trade. Anything over 10 pips will make money. There it is. It's triggered now. And the idea being, stop wise, you can place it up out the way, up here. So it's on the other side of that level. Why do you just stretch it out? Because I know straight away someone will go, that stop's bigger than your target. No. Your stop's job is to protect the account. That's it. It has nothing to do with the profit or anything. I'm looking at this objectively to see what I can get. I'm looking for 10-15 pips safely. Now if I can do that, result, doesn't matter where I put this, not at all. All it's there is just if it breaks this top level, I'm wrong and it gets me out, simple as that. But I want it far enough out that if it wicks, you know, like a big tall wick like this, and it pushes through and then comes back, it doesn't take me out the trade. So that's why I push them out the way, right? So it's just in there like so. But I've already made my mind up that I'm not going to breach this, and I want to get the price to here. Now once that's been done, how often does the price do that? It goes backwards and forwards. Now if I wanted to, I could re-enter and then come back and get it again. But what I'm trying to achieve is one safe trade per day. So what I'll do is I'll let this run out. We'll see if it hits its target. And we'll keep doing this, and then in January we'll build up a spreadsheet, and we'll see if we can make some money compounding it as well. Because like I say, I've been working on this for probably the best part of a year. Just not the same strategy, but trying different ones and tinkering with it to try and get it to a point that it can make money. And what we're looking at here is a simple strategy, and it seems to be working, but I still want to test it. I want to make certain it's pretty rock solid, because I think it's unfair to well, I kind of rephrase this while we're watching this play out. When I did it last time, I got a lot of hassle about it, and I knew it didn't work, so I couldn't say do this, do that, or do the other, because I knew you would lose money. And the amount of stick I got was ridiculous. You know, oh, you need to tell me the rules of it, I need to know what this is, when you're doing this, and they hassled the hell out of me. And some of them were quite, well, aggressive, because I said no. And the reason I said no is because you would lose money. I don't mind doing this because it's only a couple of quid, and it's just part and parcel of building up strategies. You've got to go through a pain threshold in order to succeed. It's just like any athlete training, they've got to push through the pain, and then eventually it just clicks and they've got it. Trading's the same. You've got to go through the pain, be repetitive, and refine what you're doing all the time, and then eventually it clicks and you think, gotcha. I can see where I'm placing my stops, I can see where the profit needs to be, and I can see the triggers. Now I like to use multiple confirmations. For this one, it will get easier in the sense that I'll have pre-marked the chart rather than sort of showing you a blank key levels in, so I know exactly where the arena is before I start. So that kind of shaves a little bit of time off. But then it comes down to basically one indicator and price, and then the indicator has a few settings that you can change, and you look at it in one time frame, transpose it down into another one, and then that gives you multiple confirmation as well. Because if you're just looking at a single chart, a single 5-minute chart, you won't get the overall picture, and it's the overall picture that'll make you money. 5-minute charts, 15-minute charts are only there for entry and fine-tuning. If you want to succeed in trading, you need to know how to read a daily chart, a 4-hour, an hour, even a weekly and a monthly chart. And I know that sounds mental, but if you can read them and sort of transition it down into a 15-minute chart, it does not have to make your trading powerful. And I show that all the time. So let us run this out and we'll see if we can make a few pennies. There we go, guys. Done. Killed the trade off because it's starting to show signs of pushing back. I wanted it below this line, which, as you can see, it's like pulsating back to it. It did one of the worst things a trade could actually do, and that is touch where I had the target, but it didn't quite go through to the spread to kill the trade off. Absolute pain. But why did I kill it? Because it's got to where I needed it to be. And the first initial burst came down to here, as you can see. It formed this hammer, and then it started going green a bit. So I decided, right, okay, I'll just take what's on the table, reset the order roughly where it came from, and then an additional order up there. I always let price come to me, so it was one underneath, one above, and it was going to hit one of them, and I just trailed it up to a better price, let it come, crack the target, job done. So what's it give me? And there you are, 45 quid for less than an hour. No, I know it doesn't sound a lot, but it was only £2 a position. And the idea of this is just to show you that it's feasible and that it can be done. Now, I'm still going to be testing this quite a bit, but it's pretty much there. And I'm quite pleased with the way that it's come along. It's taken a lot of back testing, a lot of forward testing. I'll touch on back testing actually. Backtesting in theory is excellent because you can see what's gone on with a trade. However, what happens when you backtest something is you're always looking for optimum conditions. And what do I mean by that? All systems work. They genuinely do, if the conditions are correct. And what you'll do when you backtest is you'll kind of number blind yourself because you will always see those conditions, and sometimes it can give you false hope. Whereas forward testing, in other words what I'm doing here, where I'm actually doing it from the unknown, that's a little bit better because you have to read what's happening in the moment. And that's what trading's all about. It's being in the moment. And you can backtest something for 10 years. But the difference with that is markets change. And what was happening 10 years ago is not really relevant for what's happening today. And you've got to be a little bit careful of that. So, in summary, we're getting there. Like I say, by all means, drop your comments below. I'm always happy to speak to you. And if you want to email me, my contact details are in the description. So as always, guys, trade well, keep your risk managed, but above all, do what you love, and the money will follow. See you all in the next one.